Hello, uh, my name is Cadis Brooks. I am just beginning a investment firm connected to my would-be conglomerates that I've been working on for the last couple of years. I have a few businesses that I have been focusing on and growing, and I've been putting my excess of capital into investments and been doing surprisingly good. Um, my plan is to give a weekly briefer, not very long, just regarding business policy, discussions related to that, teaching new people how to engage in business, open up businesses, buy businesses, and invest themselves, and then also give um, pointers on some of the popular news that's coming out regarding major industries, the Fed's interest rate policies, and then also stuff interested in popular investors that have been doing very good. My intention is to um, create a reputation and image for successful business so that people would be willing to eventually invest into a future business firm. Um, Regardless, this week I'm going to be talking about the oil industry, how I became a contrarian in regards to industries like the oil industry, and what that means in the current state of business affairs for that industry, in the sense of transitioning from um, pure fossil fuels, carbon heavy emissions into a more integrated system of oil, gas, but then also renewables and effective controls on carbon. But then also, of course, the energy crisis that we are going through. I'm actually from Canada. I'm from Victoria, BC. Um, so we are an oil-rich country. So we're not really feeling the effects of the oil crisis just yet. But of course, Europe and China, they're feeling it in a major sense. So much so that the oil prices have skyrocketed. I was also interested in discussing a quick point about Canada-U.S. relations in regard to trade, my stance on Buy America and Buy Canada financial policies for government, which obviously relates to the oil industry too, but then also steel. I personally got to get updated in the steel industry too, with regard to the sanctions that were placed on Canadian steel exports to the U.S. But then, of course, there's the climate problem as well. There might be a few topics that just pop up kind of out of nowhere if I feel that they're interesting to the discussion. But first off, of course, oil and gas is very interesting. So let's discuss what exactly has happened here. So I began investing in an American company. I think it was Phillips Partners, last year, or at the beginning of 2021. This is when the stock was still about half undervalued. It was going through a major pipeline contestation, which had affected its shares. But it's out of Texas. The company is one of the most profitable U.S. oil companies, as compared to some of the other companies that have the costs of production quite higher. And so I was lucky enough to be reading some of the good business advice, and I would always recommend that anybody interested in investing and whatnot to do their homework, do a lot of research, enjoy doing it, I have a master's degree in political science, but I also specialized in political economics and economic policy. Um, so I have a bit of an acumen for research and analysis, especially with regard to business strategy and the underlying evidence and facts and so forth. But even if you're just a beginner, you got to get out there and expose yourself to the lots of positive advice and the good statistics and the Moody's manuals, all the basics. But back to the contrarian position. See, at first I was actually quite green oriented coming out of Victoria, BC. We're obviously one of the green capitals of the world. BC is one of the freshest and green friendly homes to some of the Greenpeace members and so forth. So I came from that kind of background, but I also understood that, I mean, we use oil and gas every day. It's hypocritical for us to completely criticize it while also using it every day and not really having a backup strategy to replace that. And now, of course, there's consequences to using it, and I think that to actually appreciate that and come up with a good enough transition strategy where the oil and gas can be mitigated to the extent where it's not harmful to the environment, at least the use of it. I think you have to be equipped with knowledge and apt to understand the oil industry. You can't just completely shut off the pipes. Of course, we all use gas to drive, and we all receive goods that are manufactured in places that are gas-heavy users. And so I started to bandwagon with the leaders of the policy that says let's complement green, strong renewables, green transition with basic fundamental oil and gas from the old economy. And so I found some opportunities on the market because of course there's that market perception and even fear, especially in the oil industry, that makes people shy away from the oil industry, despite not having that knowledge and the facts that I was just mentioning about the oil industry to transition in the first place. And so if a stock is not appreciated on Wall Street or among other insider investors, including private equity firms and major conglomerates, investment conglomerates, and pension funds and other funds, if it is disfavored, the stock could often be undervalued because it doesn't have the volume of share purchases available to keep the stock at a fair value compared to its assets and its income per share. So of course you get the stock undervalued, and there was still the COVID scares in the markets that kept a lot of stocks still undervalued. And I mean, regardless of what happened and is still happening with regard to the pandemic and its plausibility and questions around that, I don't really get into that. But what I do know is that it created a market crisis that offered a lot of opportunities. Of course, just like the 2008 financial crash and the dot-com bubble and other panic sales in the history of the markets. And so it offered great opportunity to get in. You could buy really good stocks like Nike, Walmart, Canadian Tire, Home Depot. You could buy these half of their normal value regarding their assets and income, and the structure and defense as a defensive stock, in the sense of it has so much volume and so many institutional investors that the stock is a very solid investment. It's not going to move erratically or just tank because of a big sell-off among insider traders, as you would find with some of the over-the-counter stocks. So all of these great aspects, you got income, you got defensiveness, and you're able to profit big off of this COVID crisis, of course, because you're equipped with knowledge, and I took it even a step further, see, because I had already done that with actually real estate stocks. I'd already made a good a good percentage of money. I think it was over 50%, something like that. Very high on RioCan, which is one of the biggest Canadian real estate stocks. So I'd already did that, and it paid good dividends. So I came across this contrarian move of Phillips Partners, and I invested into that at a very profitable value. There was a major luck of the draw action on parts of, I think it's the Corp Engineers of America, and they decided to not intervene in a pipeline permit issue that the Phillips partners had at that time. So there was an upsurge of profit on that. That's how it started. Then oil started to do quite good as well in general. From the spring until about June, I had sold in sometime May. Obviously, that's a short-term sale, and I don't encourage people to do short-term sales unless they're on the market every day. They're well experienced in trading, well, not even trading, and even in investing, and can make decisions on their own, but then also are still able to endure a long-term investment in case your strategy for the short term, if you could even really call that a strategy, but in case that potentially expected turn of events doesn't come for you, you can still own long-term and still give yourself enough time for the stock to go up. But nonetheless, I sold at that time. This was my second COVID, because you got to understand that this Phillips Partners was still undervalued because of the COVID crisis too. But so this was my second investment in a row that profited from the COVID crisis. I then took a break from oil because, in my opinion, from the history that I've seen, it's cyclical, and around the summertime, it tends to do worse because market perception, a lot of forest fires going around, the heat's so heavy, that's when it tends to get tons of popularity, it tends to lose lots of popularity. There's probably other reasons too, of course, OPEC's in there. This is all very complex, but so the stock went down. Now I'm coming to today. I started my position in Suncor. What I did is I looked into all of the stocks that were good, that had potentially still not recovered from the COVID crisis, and of course there's a lot of garbage stocks. You could find all sorts of financials and other stocks that, especially mortgage-backed securities, one of the riskiest ones to get into. And I could get into that history of mortgage-backed securities on another briefer other than today, but and why they're risky. But Suncor was about half price of its pre-COVID stock level and price, and I understood that it tends to need more a higher price for oil because its heavy concentration in the oil sands, and which tend to have a higher production cost to refine and so forth to get the market oil, and but of course the oil prices went up, so you're gonna see that the Suncor stock has went up over the last month. I got into the position, I began in about midway through September. I had been contemplating the idea because I recently just got into condo investing as well. I sold my condo. I made a good profit. The housing market in Canada has been absolutely hot, but I felt it was a good time to leave. And so I had a lot of money. I could have put it into Suncor all at once. I decided to kind of take a step back and do quite a bit of research before I made any of my moves. But Suncor was an interesting stock to research. There was lots of research on it, which gave it a positive plus for a potential stock to get into. It also was a stock with very high volume, one of the biggest companies in Canada, and which meant that institutional investors, because of their restrictions on what kind of stocks they're allowed to invest into, and other conglomerates and stuff like that, like Berkshire Hathaway and whatnot, they have to have a high enough volume to be able to invest into, because otherwise they would just make the stock surge on its own, and they wouldn't be able to find buyers for the stock after buying too many shares compared to its volume. So if it already has a high volume, this means that the institutional investors aren't restricted from investing into it. Whereas if it's just a startup company, there's going to be limitations to how much of an investment you can put into it if you're a really big investor. And what that means for other investors is that the attraction of institutional investors and so forth will be weaker the smaller the volume is, right? So, but Suncor was also really well integrated, in the sense that it combined a whole range of different ways of making oil. Plus, it also had a good green transition plan, and it already makes renewables, I'm pretty sure, and it has plans to expand in that regard. And then it's also exposed heavily to the gas industry as opposed to the oil industry, because or at least the segment of that industry, because gas is going up in value still dramatically in Europe and China. Well, I mean, all across the globe, but especially because of Europe and China, with the gas crunch, a lot of industries want to use gas because of its supposed less of an impact on climate change. But regardless, the gas value has been surging for about a year, and isn't showing any signs of slowing down. There's a bit of talk from Russia saying they're going to be able to supply Europe what they need for energy, but that still hasn't seemed to be taken very serious in the oil and gas markets, and I guess it'd be difficult to supply the whole continent oil and gas that quickly to really affect the gas and oil prices. Plus, you could even say that it's not in the interest of Russia or OPEC to lower the gas prices or oil prices, because they of course specialize in selling those. So you could see them, producing or supplying enough oil and gas so that, of course, the ripple effects of different industries doesn't affect their economies, because they're going to need oil and gas at a relatively inexpensive price, insofar as to continue businesses that are integrated in an international system that could impact Russia or the OPEC countries. So they need to make sure that these industries are safe to the extent that they're not going to impact Russia and the OPEC countries. But at the same time, they still want oil and gas to be profitable. So they're going to find that healthy medium between the two. Oil and gas, again, is kind of contrarian here, because still in June the price surged, and I think it was about July the price started to dip for Suncor, and correspondingly the oil and gas commodities, and still there's that market perception, especially in Europe, around not wanting to invest in oil and gas, and thereby not having the supplies necessary for the use of it, which is spread all across Europe. It caused one of the worst energy crises they've seen in quite some time, at least. So that's an interesting one there. I was, but even at that rate, I mean, I could put quite a bit more into Suncor. It's an interesting investment, but I keep diversified to some extent as far as diversity is concerned. I'm currently interested in the housing market in Canada, but not interested in paying the full price for inflated homes, as in directly buying a rental property or such like, but rather finding good deals on the stock markets where you can buy underpriced shares of real estate investment trusts, and you can profit from the rise in housing prices and the constant rent income by owning these underpriced shares, which, to be honest, are actually quite fairly valued. Like I said, RioCan was one of my favorites. But I went even further than that, and I decided to do a kind of venture in not in an over-the-counter. I used to do some over-the-counter, but I actually found that there's no point in doing an over-the-counter as compared to a TSX venture stock, because both of them are about the same rate of riskiness or risk to reward ratio. But I found the OTC was just littered with fraudsters, just not enough information, very difficult to find the information. Even when you do find it, it's untrustworthy. I admire Warren Buffett and other investors that started that way, getting on the ground, finding as much information they can on small pink sheet stocks, and being able to profit quite quickly and quite rapidly, as Buffett did. And he even mentions that he definitely used to do that and could make a lot of money if he first began by doing that again, but he can't anymore because, of course, that volume limitation that I was just talking about. But I find that actually you can even reduce the risk even more. I hadn't had much luck looking at the OTC. I made some good money off a couple of the stocks, but I decided to go into the TSX venture because there's a regulation in that one that forces these companies to give accurate information, and I found that much more helpful. But on the housing market strategy, buying stocks, the one that I got into, the ticker is UFC, and that's on the TSXV for venture. And I found this is only about $1.20 a share. Now the volume is obviously quite low on this one because it's a smaller stock, but as far as diversity is concerned, I was interested in its actual dividend paying capacity. Well covered dividends. It pays about 5% dividend on a quarterly basis, which is actually quite fair, quite reasonable. And once you factor that in with the growth factor in this smaller REIT, real estate investment trust, the capacity for growth and the defensiveness of also collecting a well-covered dividend was a good choice, in my opinion. The stock has went up about maybe 15 to 20% since when I bought it. I don't plan on selling. I also follow the advice of Charlie Munger that you want to own a good stock for a long time. I mean, Peter Lynch as well. I'm one of those buy and hold kind of guys. I put most of my money in a buy and hold strategy with exponential growth factors for potential. And I mean, Buffett himself, he says something about real estate not being a popular investment for him because of the difficulty of building new houses, and the ratio between the rent and the cost of making a house isn't that great. And fair enough, with all due respect, he's done very well with basic consumer cyclicals, where the potentiality of holding a range of stock and having good margins on each item, and then being able to sell limitlessly at all these different stores, obviously limited by the hours of operation and so forth, but the limits are very high on that kind of sales oriented stocks, and he's done well with that. But the idea is that with the Canadian housing market skyrocketing in value, and buying these shares of real estate investment trusts at much lower cost as compared to the price of housing, the idea is that the stocks are going to gain just on that undervalued assessment, since the shares are actually worth quite a bit more because you're buying into something that's worth so much, like housing, in the sense that you're buying assets of this company. If you look at it, you buy a stock, and how much of that value is going to be related to the assets, and then how much do you get in assets for the stock's price? Well, it's actually quite high for real estate investment trusts, and the de facto value of what you're actually buying is something really consistent, easy to understand, because the rental economy is something very easy to understand when you're getting paid for your rental income, and generates each month, and you got a certain percentage of rentals fulfilled, in the sense you got 95% of the all owned real estate rented out. You can quickly understand the stability of it, and it offers a lot of good defense in that respect. One of my best perspectives, I think, in investment strategy is actually the four elements of common stock assessment criteria. So you get the defensiveness of the stock. That's what they call stalwart. The stalwart aspect, and then you get the value aspect, which is going back to Benjamin Graham's innovations of looking at how much do you get in assets and income for each stock that you buy, and if the stock value that you're paying is lower than the assets, and with the income also factored in to the equation, if the stock price you're paying is lower than the assets you're getting a good deal. That basic fundamental that rarely proves wrong. And then you get also the growth factor, in the sense of what are the growth potentials in a stock when it is spending a lot on one-time investments that are going to be good for the foreseeable duration of the stock, new investment properties, new capital goods. I mean, there's depreciation too, which is why, of course, you have to do your business analysis, do your accounting properly. But of course, there's the growth factors of expanding into new markets and increasing your expenditure on marketing and offering reliable goods. Something like, of course, Apple, it offers a really reliable good, and the more people see that, the more it grows. There's that growth perspective. That's three. And then the fourth one that they commonly look at is its dividend, in the sense of how much dividend does it pay? Can the dividend be supported by the income, which is the dividend ratio, the dividend to income ratio. And then another factor that I look into with regard to the dividend is it gives you a bit of defensiveness as well, because despite how well the stock does, of course, unless the stock completely tanks or the dividend gets slashed, you get a consistent dividend that pays regularly, and you're going to beat interest rates just from the dividend, in the sense of interest rates that you get in your savings account or for treasury bills. you're going to beat that with the dividend that companies are pay, and then of course you look at a company and you look at its feasibility based on its dividend capacity, and whether or not it has paid a dividend for however long. But when I looked at the UFC TSXV stock Urban Fund, it had the 4 credentials, all 4. And that's the point of me explaining this 4 criteria, is that in a lot of these stock books nowadays, you're going to get stock pickers that will favor one style over the next. You get some guys who like growth more than income from dividends, or the growth more than value, or whichever combination you prefer. But I look at it as, let's get stocks that have all 4 criteria covered. And of course, some are going to have a little bit better in dividend than growth, or growth in dividend, or defensiveness than value. And at that rate, what you can do is you can say, well, if I'm more interested in growth than the rest of the 3, let's get one that has high growth, the highest growth, but then still the other 3 covered. Even if the value isn't as great, or even if the dividend isn't as great, at least there's still something there. And because when you're picking stocks, you got to understand you can look for the perfect stock. You know, when you have the accounting skills to go through financials, and also the qualitative factors, you can keep looking. There's no rush to get into a stock. There's always a good opportunity. If anything, there's too many good opportunities, which forces you to potentially sacrifice one good opportunity at a loss for some supposed future gain from some better opportunity. And then once you get into that, you think, oh, well, now there's even a better one, so I'll take another loss. And that's how you lose in the stock market. That's how you lose in investing. You never want to sell at a loss. That's one of the foundational Warren Buffett principles. Don't worry about better gains. You could have made some better move. It just goes on and on. Stick to what you're doing. Go for a long-term strategy. Go for a long-term strategy, and don't sell unless you have to, or unless you've made the proper criteria evaluation to sell. And so actually Suncor also fulfilled all 4, and all 4 of those criteria I was talking about, and also the Phillips Partners did as well, all 4 criteria. Same with RioCan, all 4 criteria. And I have been profiting since I finished my accounting degree, or not a degree, sorry, my accounting class in about a year and a half ago. Of course, I still have a master's degree in political science, specializing in political economy and economic policy and whatnot. But learning the accounting principles, how to read financials, how to read income statements, that was absolutely fundamental. I did quite well in the class, and ever since then, I've been applying these 4 criteria to all the stocks I ever invest into, and I've made good profit on each stock. I've beat the market one time after the other on short terms, which I don't like to say, because I like to be a long-term investor, just like Buffett, and buy and hold and get those multi-baggers, of course. But I can't deny it that the COVID crisis has really put a lot of good deals on the stock market, and I've invested in one after the other. So I want to share that information with new subscribers, and even appeal to some of the institutional investors and different conglomerates, the kind of skill and knowledge that I have. I am looking to open up an investment firm in the near future. It's going to take a lot of work. I already own a couple of businesses and do well myself. What I do is very similar to Warren Buffett. Is I own, start up, and buy businesses, and then I take the excess of profits that I don't really have a first use for, no priority use for it, and I invest that excess into the stock market with professional, very well detailed stock analyses, and it works and it functions in that diversity itself. You own some businesses, you're starting some businesses, but then you're also into a few stocks as well. And I'm not the biggest fan on diversity either. I understand that Buffett comes from a tradition of quite a bit of diversity. Still not as much as some that I've seen, and I think that Munger has a good criticism to that style, in the sense of it multiplies the work that you have to do if you're having to diversify into more and more stocks, and that he likes to select a handful of stocks that he's really positive about, knows lots about, and in that way make investment decisions and keep up to date and be more intensive in his research. And I do go with Munger on that, but then I like Buffett's strategy of having your handful of stocks like Munger, but then also a range of businesses in the same town. Especially, I find that if you got to expand franchises into different cities, that's the locality strategy will just make it so much more difficult. And I'm not saying it's impossible. Of course, there's lots and lots of franchises that do very well, but I find that there's an added strategy, an added value to a local strategy, that you have many businesses in the same city, like Omaha, Buffett himself, what he did in Omaha, and then you can affiliate advertise with those businesses. But then back to the point of diversity, you have this diverse range of businesses that you own, but then also the stocks, the diluted ownership of the businesses through stocks, and in that way you stay diversified. I do acknowledge the Buffett history of finding really good deals in the past, of course, but not in the present, when buying new businesses or buying existing businesses. And so if you read into the history of Buffett's financial success, of course, he was buying businesses that were better than the asset value, that the price was cheaper than the asset value, and the profitability of those businesses added to the good deals that he got, and that he became quite wealthy through buying these and developing conglomerates. But then in more recent days, he's having a harder time finding good businesses at good deals, not through the stocks, but through actual ownership, undiluted ownership. What I would say in reply is that I do notice that when you're out looking for businesses, that it's very hard to discern which businesses are going to be profitable for the price that they want. And I tend to prefer actually just starting up your own business, and you've got to have extra time to be able to do this, but it's you could start up a business for $5,000 yourself, a few $1,000s, and develop and build it that way. And if you got the time, you can build it like that. You can start up another one in the locality, and then affiliate advertise, and it expands that way. I still think that strategy is still golden to not throw that one out. You can start your own business. You can start many businesses. You can do quite well. There's no limitation there. You won't get ripped off by people who are way overcharging for something you could start up for like I said, $5,000-$10,000. Buffett never had the time, supposedly, is what he said. But I think that there's many people out there that do have the time and would prefer to own their own business. And so I can recommend, as I have had some success myself. As far as the last point here, just on this briefer, it has went some length here. Maybe not all my videos will be as long. This is my first video, of course, so I didn't want to cut it short, especially when the discussion was getting so interesting. But I think that now I got a master's degree in politics, so I could probably talk with a lot more expertise in politics. I'm actually interested right now in the Canada-U.S. relations with regard to the steel. A pipeline just got approved, and there's been some hostility in the Trump administration. Maybe little less than hostility, of course, because he's a bit bombastic and he's trying to get ratings. Of course, he used to be a dramatist as a comedian or such like, and so there definitely was an opposition to this international free trade policy that has long been in the history of the international trade between the U.S. and Canada and the U.S. and Europe and other countries. But I think that right now, I've seen Chrystia Freeland. She said something about if the Biden administration continues to trump a Buy America strategy and doing that at the cost of the relations, the trade relations between Canada and the U.S. If it comes negative, that Chrystia Freeland is going to limit the contracts that U.S. bidders can get. Something of the matter. I don't want to get too far into the details on the nuts and bolts of that, but what I want to say is that I don't think that it's a smart foreign policy endeavor to challenge the Biden administration, but rather to offer a greater alliance strategy. Let's renew that old-fashioned Canada-U.S. alliance strategy, especially in free trade. Let's get these borders, these walls that Trump put up, let's get them torn down and prove to them that we have been a working ally, especially in trade, for so long, and let's renew our relationship and expand our trade. I mean, let's put on a show. Let's really get some expansion in international trade between Canada and the U.S. I think it's a perfect time. I don't think Biden is opposed to it. I think he looks to the Liberal Party here, to Justin Trudeau and Freeland, as Liberal partners in the international realm, and I think a lot more attention could be paid to the trade between the two countries, and that the old barriers can be removed. Let's get the steel industry going. Let's supply them oil with a good green policy behind that, a good green transition policy behind that. I think it'd be good for the markets, especially now that we just went through the crisis. We don't want one crisis after the next. It really does hurt the finances of small businesses and consumers and citizens. But if we got spending for our international trade policy, let's put it on this. Of course, there's going to be other priorities. I haven't gone into the whole situation in the international policy realm for Canada. There's other allocations that are going to have to be made, most likely. But I think that one would be a smart move at the top of the international policy agenda. One last point, there's been this talk of basic income, guaranteed basic income, and I have to emphasize that I know I just praised Buffett and Munger quite a bit for their great financial strategies over the years, but I mean, at some point you do have to say these guys are making way too much money. Amazon, these macro companies, these Elon Musk, these really rich superstars in the markets. At some point, and even they agree that there has to be strong taxation policy, and that I think that basic income, to some extent, maybe $500 a month, $1,000 a month, something at least small to help people. It's definitely on the table to be analyzed. I especially think it's important to look at the financials of the Canadian budgets, the debts. I don't think that we want our debts spiraling out of control. I think that goes without saying, and I even think that our U.S. counterparts are understanding the same points with their reluctance to continuously raise the debt ceiling, especially without a feasible strategy to pay off that debt, or show goodwill, periodically paying it down. But you look at the financials and the budgets of Canada, and you say, how much did this COVID funding cost us? It did provide quite a bit of good. A lot of people really appreciated it. There's been people stuck in this chain of labor for their whole life, or their whole adolescence and adult life of late, and in the sense of someone's 25, he's been working in the food industry since he was 14, every single day, 5 days a week at least, all day, barely can pay rents. Inflation's out of control for housing prices and the cost of living with regard to rent, especially. But you take a look, how much did it cost us, and how much could we do in the future? How much growth do we get from it? What can we afford? Obviously, we don't want to run the economy right into the ground. And even at that rate, if you can't afford the basic income, I would say at least have some sort of periodic, even sporadic balancing act where you do come in and, as a government, give to these poor people that are stuck in this chain of labor, and you have this periodic and sporadic strategy of when you can afford it. You pounce and you give out enough for people to survive and enjoy themselves, or at least enough to survive. And you don't have to have a basic income all the time, but you have this program where when we can afford it, let's give back to our citizens, right? And that kind of surprise out of nowhere, where there's some guaranteed income for a period of time. I think that if you could at least afford that, those kind of balancing acts, they fall within the history of politics in many countries, whether it was on the government's decision or not. And many governments have changed and been thrown down because they haven't given back, and then eventually they end up giving back anyhow to mitigates the perception for revolution, or for change of government, or sort of strife, or anything like that. And not that I wouldn't endorse anything like that, but throughout history, there's always been this balancing act that I think that governments can understand, and instead of waiting until it's too late, act with initiative when the opportunity abounds. I think that's an interesting strategy. It's one that I've hypothesized to some extent. But that does it for the weekly briefer. I will come up with more interesting ideas and updates as I go along, and update weekly. And if you want to comment, you can add comments. Please do like the video and subscribe. And if there's interesting comments about what people want me to talk about with regard to financial policy, economics, business, politics, that kind of thing, I am always interested. Okay, have a good day.